Prior to this year, it was usually a pretty good bet to buy the dip. Well, anyone trading these days who bought the dip has been run over big time. Instead, sell the bounce has been the better play for obvious reasons as this bear market continues. I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the traders on our proprietary trading desk are trained to understand patterns emerging in the markets and to trade option strategies that exploit those patterns in an optimal way. Now, in today's video, we're going to be teaching you a very simple approach to selling the bounce that has a surprising feature that I think you're going to find interesting. So stick around and you'll see what I mean. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. Earlier this month, the market officially entered a bear market, with the market down as much as 23% in mid-June. And what's been remarkably consistent about this sell-off is how literally every attempt at a bounce is met by an even more ferocious round of selling, which happened yet again this past week, with the pattern being, in all but one case, a very short-lived bounce of maybe 4 or 5 days, followed by an aggressive sell-off that brings the market down to a lower low, which is, of course, the classic pattern of a bear market. And so professional traders, when they see patterns like this, will often employ the option strategy that we're going to be covering in this video. Now, before we get into that, I wanted to let you know that if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. Okay, so in order to explain how this strategy works, we need to make sure that everyone watching the video understands how index options work. So we're going to do a really quick review of them, and then we'll jump right back into the details of the lesson. The best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known the strike price of the option on the day the option expires. If the index closes above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay off $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless because the index didn't close above 40.75, so the call seller just pockets the premium. And the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put strike price of 40.75, but the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike price. All right, with that said, let's head back to the first day of February of this year. And as you can see, the SPX index had stabilized for a few days in late January and then subsequently bounced in the final days of January, opening up yet again on February 1st, the third straight day of this particular bounce. So let's say that towards the end of that third day, we went ahead and bought a put expiring on the 25th of February at the 45.45 strike price, right below where the market closed. And as you can see, the cost of that put is 85.25. So this is a clear bet that the market is going to sell off after the recent bounce. And so now let's move to 16 days later, which is February 17th. And as you can see, after bouncing a few more days in early February, the market did actually resume the sell-off, which continued pretty aggressively through to February 17th. And so suppose that on that day you sold the 44.70 put, which is 75 points below the original 45.45 put, forming what options traders refer to as a bear put spread. Well, on that day, the price of that put is 113.60, and that's a pretty significant fact. And why do I say that? Well, if we analyze the cash flow of what's happened so far on this trade, you can see that we received that price of 113.60 for the 44.70 puts on February 17th. And remember, you get paid $100 for each point below 44.70 when the puts settle. So you multiply that by 100 and you get the total of $11,360. But you then have to subtract from that the cost of the original 45.45 put, which, as you can see from the calculation, cost $85.25 for a net cash flow of $28.35. Keep that in mind as we proceed to the day that these options expire, which is February 25th. And as you can see, the index closed at 43.8460 on that day. And so now we're in a position to do the final valuation of this trade. And so let's start with the 45.45 put that we own. Well, to calculate the settlement value of a put, you take the put strike price and you subtract from that the closing price on the day that it's valued, and you multiply that by $100. So as you can see, that brings in $16,040. But on the other hand, we do owe money on that put that we sold because the market closed below that put as well. And so we've got to pay out $85.25 on that obligation. But then, of course, we received a net cash flow for the bear spread of $28.35, as we showed you earlier. And so the net result of the trade is a profit of $10,335. There's another point that we need to make about this trade, and that is the change of the risk profile on the trade as it proceeded. You see, originally we paid $85.25 for that 45.45 put. But once the market sold off aggressively, we were actually able to sell the 44.70 lower strike price put for $11,360, a full $2,835 more than we paid for the 45.45 long put, thus putting ourselves into a positive cash flow position. And once that happened, then we become fully risk-free on this trade. Why? Well, think about it. There's only 3 cases that could possibly result from this trade. If the market closed above 45.45 the day the options expire, then both puts expire worthless and you just keep the cash you received on a net basis. If the market closes between 45.45 and 44.70, then you'll get whatever value you receive for the 45.45 puts, which depends on exactly where in between those two prices the market closes, plus you get that $28.35 credit you received for the trade. The 44.70 put, of course, would expire worthless because the market closed above it. And finally, the market could have closed, as it did in this case, below 44.70, in which case, regardless of where it closes below 44.70, you'd still make that exact same $10,535 as we did in this case, because once you get below 44.70, and in this case we closed way below 44.70, then the settlement price of the 45.45 put will always increase at the exact same pace as what we'll need to pay out under the 44.70 put, freezing the value at $10,335. So in other words, the worst case scenario is a profit of $2,835, the positive cash flow resulting from selling that 44.70 put for more than we paid for the 45.45, which in turn resulted in the market selling off after we bought the put, which was the premise of our trade in the first place. So what I'd like you to take away from today's video is that if you're correct in your bearish thesis and you buy a put to take advantage of a bearish move if the market moves down, you can put yourself into a very comfortable, risk-free position by selling a put below the one you bought if you can get it for a price greater than what you paid for the original put. In that case, you're guaranteed to make money on the position regardless of where the market closes on the day the options expire. Professional traders love getting into risk-free positions where they lock in a profit on a trade, and then it's not a matter of if you'll win, but rather how much you'll win. And that is a nice feeling. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you could just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.